did see a broad sell-off across global markets in March, and fixed income was certainly part of that. We've seen a little bit of a recovery, but could you talk a little bit about what's going on within fixed income markets specifically?
Sure, and I think it's important to, again, emphasize the unique aspects of this particular crisis environment. We saw a situation several weeks ago where there was a significant economic shock, a shock to people's work environments, and you had a situation where the highest quality segments of the market began to break down in terms of their overall functioning. And in fact, we noticed early on, during the crisis days, that the most dislocated sectors were areas that should be liquid and well insulated from credit loss, namely things like U.S. Treasury bonds and agency-guaranteed mortgage-backed securities. In response to that extreme volatility, we have seen policymakers step in and provide tremendous liquidity support. And in the process, we've begun to see some gradual stabilization in the higher quality areas that I just talked about. So today, in terms of PIMCO assessing opportunities, we're increasingly comfortable with higher quality risk that should be and is in many cases AAA from the perspective of risk of permanent capital impairment, and then sectors like agency mortgages, despite a considerable recovery over the last few weeks, look attractive.
Let's talk about mortgage-backed securities. This has been an area of conviction at PIMCO for some time. So how is the IC thinking of the impact of the crisis on the housing and mortgage markets, and will that affect PIMCO's conviction?
Sure, so let me just start with fundamentals. There will clearly be some cash flow disruption in segments of the mortgage markets that would only be appropriate given the shock that borrowers are facing all around the country, or in fact even all around the globe. However, going into this crisis period, housing fundamentals in the United States and in many other regions of the world were the strongest that they have been, in some cases, in a couple of decades. Very conservative lending coming out of the last crisis that occurred well over a decade ago, a steady period of rising home prices and therefore very high levels of borrower equity, and a tremendous degree of conservatism in terms of underwriting standards across this space. So that as a backdrop makes us continue to believe that these sectors are going to be quite resilient from the standpoint of ongoing performance and avoidance of significant capital impairment. Also, I think it's important to note that some of the more recent volatility that we've seen within the mortgage space is not related to concerns around the economy, but rather has been the result of some deleveraging activity that has occurred in certain leveraged segments of the market. So there's been a lot of recent forced selling out of the REIT community, out of certain segments of the more levered hedge fund community. That can continue for the next several weeks, represent attractive opportunity for investors that have additional capital, but isn't going to last forever. We think that this is going to be a brief period of significant opportunity to acquire assets from forced sellers.